Hi, I'm Wong, Director of Phillip Capital Management, Hong Kong. After stabilizing briefly following the sell-off in June and early July, China's stock markets saw another sell-off starting mid-August that sent the Shanghai Composite Index falling from above 4,000 to a recent low of 2,850, representing a decline of nearly 30%. The recent sell-off is triggered by disappointing economic data and the yuan depreciation. The preliminary reading of Caixin China Manufacturing PMI fell to a near 6.5-year low of 47.1 in August, below market forecast of 47.7, and the official PMI falls to 49.7, the weakest level since August 2012, and also the first time falling below 50 in the last 6 months. Both PMIs underscore persistent sluggishness in China's manufacturing sector and signal further slowdown of the economy. While China's yuan has stabilized after the sharp depreciation in mid-August, we do not expect upcoming economic data to show any marked improvement. This will keep the stock market under pressure. The Shanghai Composite Index may test the support level of 3,000 again. Our research department has issued a report on Inner Mongolia Yili Industrial Group, abbreviated as Yili, and the stock code is 600887. It was the first dairy company in China that is listed on the Shanghai Stock Exchange. It was listed in 1996. Yili is the largest dairy producer in China. Its product includes milk, milk powder, yogurt, and cheese. The company's revenue increased 14.1% to 54 billion yuan in 2014, and its net profit grew by 30% to 4.2 billion yuan. The full-year revenue is expected to increase 14.4% to 62 billion yuan in 2015, and its net profit is expected to grow 30.2% to 5.4 billion yuan. Our research department maintained a buy rating for Yili. The target price is 26.4 yuan, which represent 65% upside to its last traded price of 16 yuan. The target price of 26.4 yuan is equivalent to 30 times the forward PE for 2015. I received an email from an investor in Singapore named Peter. He said he noticed that over the past few days, the big three banks, namely Bank of China, ICBC, and Construction Bank, the H shares dropped 1 to 2%, but their A shares increased 6 to 8% per day, and their AH discounts have increased to 25 to 30%. He wished to know what are the main reasons for the opposite movement of the respective A and H shares, and what's my view of the banking stocks, whether their high dividends are safe. The divergence in valuation between dual-listed companies in China and Hong Kong, the cause of decline in the H shares of banking stocks is mainly due to lackluster interim results. The interim results of the big four state-owned commercial banks range from 0.3% to 1.5%. The combined NPL balance of the big five state-owned commercial banks increased by 136 billion yuan, or 26.96% in the first half of 2015. The divergence in the movement of H shares and A shares of banking stocks is probably because China's government is supporting the stock market through large-scale purchases of stocks with heavy index weighting. On 2nd September, the day before Beijing hosting a military parade to celebrate the 70th anniversary of the World War II victory over Japan, China's largest state-owned commercial bank, ICBC, went limit up in the last hour, half an hour of trading, after being in the red most of the morning. The outlook for Chinese banking stocks will remain challenging. The sluggish interim results signal that borrowers are having trouble repaying loans. Special mention loans, a category that banks deem overdue but not yet impaired, are rising. In addition to increasing bad loans, China's slowing economy raises the likelihood of more interest rate cuts, which will further pressure banks' net interest margin. That explains why more and more Chinese banking stocks are falling below net asset value, and that may not be a bargain. If you have any question about A shares or the China stock market, please feel free to write an email to me. My email address is cs@phillip.com.hk.